Hey everybody, welcome back to Ryan Makes Sense, where we talk personal finance, investing, and chart analysis. Today we're looking at ticker symbol CCL, Carnival Cruise Lines. We are going to see if the stock deserves to be around $16. Should it be higher or lower? We're going to run our stock price projection calculation, see if we could trend higher or lower, and also see if hedge funds and institutions are buying or selling, which kind of couples with my calculation. We'll also look at the balance sheet, excuse me. So without further ado, let's go ahead and jump on in. Struggle bus here. Okay, we're looking at the bigger picture because this one got annihilated during COVID. So looking at potential price projections to the up and the downside first and foremost. All right. Whoops. We have got, I'm just looking right, probably right here. About $19 is going to be our first resistance to test to the upside. However, if they do smash earnings, I think the next test would be, gosh, quite a few. 21.92, and then getting right there, 30.28. So those are our three upside targets. Now, if the stock does fall because profitability guidance or just Wall Street doesn't like the way the CEO said something, our first support is going to be around 1326. And then our second line of support is going to be. Heck, let's go down here. 1132. And that's if earnings are bad. And then we have our all-time low base, at least in the last 4 years. Again, COVID came all the way back down, tested this double bottom right here, confirmation, went from 824 to 31, back down to test it again. It's proven that this is a great area to consolidate, and now we're at 16ish and some change. Will it get back down to 850% drop? I don't know. We're gonna look and see what's going on here. So looking at our strength, it's above 50. I think the bulls have this in their favor. If earnings are great and we do see an influx of volume, they could really take it. However, it's at that midline where if it's a horrible earnings report, bears could attack this and probably send this lower. We have been extended to the upside on the momentum at least since the beginning of 2023. So it's just been kind of onward, upward for the last 1.5 years. Could it take a break? Yes. Money flow definitely looks like we've curved from a low upwards, came up, taken a breath, now curve back up. Could it go back up? We're not sure. Relative momentum indicator is at a 43. We do want to see this treading closer to 50. However, I mean, we've got a nice low here, come back up, nice low here, come back up. Going to create a new low, question mark, or is it going to just rally upward? A lot of uncertainties with our technicals here. I do see this is pretty balanced in the bulls and bears favor. I think this is going to lead to a lot of volatility on earnings tomorrow. And I only say that because momentum is extended, money flow it's above 50, which is good, but it's also at the same time on a drop of a dime we could see instant selling, which our money flow would go completely down. And our strength is right in the middle. Honestly, it's at 51. So we're gonna run my calculation, but first, before we do, I mean the EPS. This is a Cinderella story. COVID slammed them, boom, just trucking right back, trucking right back, trucking right back. Looks like we're gonna be at a positive EPS for 2024. Sales have rebounded pre-COVID levels, and now they're exceeding in 2023 what they had in 2019. Shares outstanding looks like they diluted a little bit, sold some shares, got some money. I guess understandable. Red flag right here, quick ratio is a 0.32, meaning if they close their doors tomorrow, They would not be able to pay off all of their debts, liabilities, notes, etc. So that's a red flag. However, they're profitable. And this is part of the turnaround story. It's going to take some time to get back to a healthy quick ratio. At least that's what it looks like. Debt looks really high, but you can see from 4.79 to 4.44, it does look like they are addressing the debt. Sales over the past 5 years, very nice, 97%. Fantastic. I mean, gross margins 24%, kind of coming back to very high gross margins, considering that it's possibly a high growth company now that it's rebounded pretty quickly. Okay, we've looked at that. Let's go ahead and just get the institution and hedge fund data loading while we continue. So it's in the S&P 500. We're going to do the 21 billion 160 million in market cap. Good for them. Plus, they do have positive income of 405 million. And they do 22 billion 570 million in sales. Insane. They're already surpassing their 2023, so clap, clap, clap. Good job. Okay. Yeah, onward with this calculation. I want to see what insiders are doing. David Bernstein sold, wow, a lot of shares. It's a lot of shares. Randall Weisenberger, on the flip side, bought a bunch of shares. So, all right, back to our, just make sure it's USD. It is USD. All right. So they have a plus 2,274,000,000 in cash, right on the nose. 2,204. Okay. Total debt minus 29,682,000,000 on the nose. All right. And total assets 49.7 billion, total liabilities 43 billion. They've got a nice $6 billion buffer. Good for them. No concerns there. I mean, again, this is companies on the rebound. Their quick ratio will improve over time naturally. I saw that their debt was going down, but it looks like their debt's actually going up. Total liabilities again going up. Total assets again going up. So they're going to need to make some decisions to make that more efficient, in my opinion. But again, no real red flags. Insider buying and selling, no real red flags. All right, we're going to take this and we're going to divide it by our shares float, divided by 997,880,000. Saying a stock price of $16.76. Wow. Right, basically where it's at right now. So this is pretty fair value. Analysts have a price target of $20. Given the comeback and where they are today, I think this is a decent company to invest in individually. And I only say that, this is why I say that. Let's pump our brakes. This stock is trading at the same level as it was right during COVID or whatever great lockdown was at. So, and they've definitely rebounded since then. And I think they're becoming a little bit more efficient. We can see they're slowly paying off their debt. I couldn't really see it there, but we have this data here. I mean, their gross margins are really nice. Profitability is coming back. They're really expensive currently, but if their current guidance, revenues, etc., heading into the future, it makes this company cheap, and I agree. So institutions own 51%. That is old data. New data, the new data that I'm about to show you has SEC filings up to the date. So remember, 51% old data, 53% new data. So that's about a 2% increase overall. And we're going to see what the big boys and girls are doing. Actually checking. I mean, back to all-time highs of institutional ownership. And this goes back to 2019. So these levels are higher than they were back in 2019. 2019 was trading at 42. So just some food for thought. I don't even know what that saying means. Vanguard added about 2 million. Well, gosh, 1.2 million shares. Arson Mickey Mir decreased from 121 to 85. BlackRock increased roughly 3 million, give or take. So that's the update there. Is Arson Mickey Mir, is he? I'm just saying if he's the executive chairman, so he's sold some of his stake, which was not captured down here. So Mr. Mickey Mir sold 15, 36, around 35, 36 million shares. He sold 40% of his ownership. Mr. Mickey. I think this is a decent area to buy. That's my opinion. Wait till earnings is over, honestly. I think we're a little extended on the momentum. But I mean, if you're gonna make this a long one, if you're gonna own this one for a long time, we have our inverted head and shoulders here, left shoulder, head, right shoulder. I mean, a lot of build up here. Again, if we have an amazing earnings, we could see this go up, 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 and up right here. So, or it could go the opposite way. You never know. Earnings are unpredictable. So talk to your financial advisor about that one, or whoever you seek your investments from. It is an S&P 500, so if you wanted to have exposure to this company, owning the S&P 500 would give you some exposure. So there's some more food for thought. Anyway, we talked about upsides, stock, if the stock has good earnings or bad earnings, those targets. We saw institutions and hedge funds added 2% overall. We ran my calculation, and my calculation says the stock price right here is good. Their balance sheet is improving. Quick ratio is a little bit of a scary number, but I think it's improving. I think their profitability will improve. Again, we've got a little Cinderella story kind of right here. So thank you so much for watching. If you made it this far, consider subscribing. And if you're in this one, good luck. I'm excited for this one. Take care.